CEO and Managing Director, Mr. Abhishek Thakkar, the Chief Financial Officer, and Ms. Trivenika Awasthi, the Investor Relations Officer of Niyogin Fintech. Before we proceed with this call, a disclaimer. Please do note that anything said on this call during the course of the interaction and in our collaterals, which reflects the outlook towards the future or which should be construed as a certain forward-looking statement, must be viewed in conjunction with the risk the company faces and may not be updated from time to time. More details are provided at the end of the investor presentation and other filings that can be found on our website www.niyogin.com. Should you have any queries or need any further information at the end of this call, you can reach out to us at the email address mentioned in the company collaterals. With that said, I would now like to hand over the call to Mr. Tashwinder Singh. Thank you, and over to you, Tash.
Thank you, Ravi. Good morning, everyone. Let me start by thanking all of you for joining us this morning. I welcome you to Niyogin Fintech earnings call for Q3 and 9-month FY2024 results. As always, I would like to start by giving a little brief about our company. Niyogin Fintech operates on a tech-centric platform-based model, offering banking as a service through our subsidiary iServYou and credit solutions to both rural and urban areas in India. We employ a partnership-led strategy, collaborating with local enterprise partners that possess extensive distribution networks. These partnerships allow us to leverage the partners' infrastructure for cost-effective outreach to our targeted customers, primarily micro, small, and medium enterprises, the MSMEs. Once we onboard a partner, iServYou Technologies' banking-as-a-service platforms are integrated into the partner's customer-facing touchpoints. This integration enables these touchpoints to offer banking, payment, and financial services to their local clientele. By adopting this partner-led approach, the company can effectively extend its services to a larger number of MSMEs and SMEs through each partner it engages with. The revenue model primarily revolves around transaction fees or commission earned on every transaction processed through the platform. As an NBFC, Niyogin extends its services to MSMEs by providing credit. We facilitate lead generation and provide digital access to credit and other financial services for MSMEs through our distribution platform, NeoBlue, and also via several fintech partnerships. Niyogin employs various lending models and generates revenue through either interest income or fees associated with the loan lead generation. Let's get into the quarter that's gone by. I would like to share with you 3 key developments that have happened recently. We are excited to announce that we are actively evaluating the acquisition of a comprehensive toolkit to augment our solution suite, particularly in the realm of AI-based assisted and unassisted tools for our partners. This platform offers a wide array of functionalities designed to enhance the digital legibility of both physical and archived digital documents. Among its features, it significantly improves OCR accuracy without requiring manual intervention and facilitates the conversion of unstructured data into structured formats. The integration of this toolkit into our operations promises to revolutionize the process of gathering and maintaining KYC-related customer information. Further, it will empower field agents by providing seamless onboarding capabilities, especially in regions with limited network capability. We believe that this acquisition will greatly enhance our capabilities and further solidify our position as a leader in providing innovative solutions to our partners. I am also happy to announce that we have successfully resolved the issues affecting our UPI business well ahead of our initially communicated timeline of 2 quarters. This achievement underscores our agility and dedication to rapid problem solving, ensuring seamless and uninterrupted service for our esteemed customers. Furthermore, over the past 3 quarters, we have been consistently booking provisions in accordance with the ECL norms. Important to emphasize that provision practice adheres to an accounting standard aimed at accurately reflecting potential credit losses, utilizing a robust assessment framework. Almost 80% of our receivables that are more than 90 days overdue have been provisioned for. As a result, we anticipate that the majority of the issues are behind us. Additionally, we see a strong likelihood of recovering these provisions, and to support this effort, we've established a dedicated collection team where necessary and are exploring alternative resolution mechanisms. Now, talking about the performance for the quarter gone by, our lending business increased over 80% at rupees 159 crores.
Excuse me, sir. I'm sorry to interrupt. Sir, your audio is not that clear. I would request you to talk on the speaker, the laptop speaker, please.
Okay. Is this better?
Yes, sir. Please continue.
Yeah. Okay, I will talk about the performance for the quarter gone by. Our lending business increased over 18% at 159 crores as we continue to ramp up the loan book. In our pursuit of constructing a high-quality loan portfolio with attractive unit economics, we have implemented a comprehensive strategy centered around 3 pillars of growth. The first pillar entails leveraging our partner-led distribution channel. We are dedicated to scaling up our business with existing partners while actively seeking opportunities to onboard new ones. This approach allows us to expand our reach and access new markets efficiently, as mentioned earlier. The second pillar revolves around our commitment on risk management. We are employing advanced analytics on large volumes of internally generated data to conduct comprehensive risk assessments. By leveraging data-driven insights, we can effectively mitigate risk and make informed lending decisions. The third pillar focuses on achieving technology-enabled cost efficiency throughout the loan process. By leveraging technological innovations, we aim to streamline operations and reduce overhead costs at various stages of the loan cycle. This emphasis on efficiency enables us to optimize our resources and enhance overall profitability. Together, these 3 pillars form the foundation of our strategy to build a sustainable and profitable loan portfolio while delivering value to our customers and stakeholders. We remain confident in our ability to capitalize on the credit opportunity in the MSMEs and remain driven by unit economics. During the quarter, we added new partners like Karma Life as a partner on our lending platform. Karma Life provides finance to the gig and blue-collar workers and empowers them to become financially resilient. Going forward, you will see the lending book contribute significantly to our profitability as it starts achieving scale and operating leverage on the back of the partnerships we are forging. Talking about the banking as a service business, that had a subdued Q3 with GTV or gross transaction value, including payouts, at about rupees 11,259 crores. Monthly GTV for January 2024 was at 3,450 crores. That's 3,450 crores. With the normalization of UPI economics from February 2024 onwards, we expect to resume our growth trajectory in Q4. Our revenue ex-device sales stood at approximately 55 crores, up 16% Q1Q, due to the positive impact from booking a part of the prior quarter's service revenues. We processed nearly 42 million transactions, which was about the same as last quarter, and we expect the UPI volumes to scale from here on. In the coming quarters, our GTV trend is expected to further strengthen as we expand our footprint and explore selling opportunities within the existing partner network. We remain steadfast in our commitment to growth, both organic and inorganic. Current market conditions have presented us with opportunities to consider the acquisition of several compelling bolt-on businesses. We are actively involved in discussions with various complementary enterprises. Our criteria for engagement revolves around several key factors, including appealing valuations, synergies with our existing business, adjacencies to our current markets, and the potential to enhance our technological capabilities. These parameters serve as a guiding principle as we navigate these discussions and evaluate potential opportunities. We are optimistic about the potential for strategic acquisitions to further strengthen our position in the market and drive sustainable growth for our company. I would now like to hand over to Abhishek, our CFO, to take us through the financials and other details of Q3 FY24. Post that, we can open this up for questions and we can address all your queries. Thank you, and over to you, Abhishek.
Thank you, Tesh. Good morning, everyone. So before I take you through financials, let me give you some update about our operational metrics. Gross transaction value, that is GTV including payouts, stood at approximately 11,259 crores in Q3 of FY24, a marginal decrease of 3% QOQ and up 219% year-on-year. Our transaction volume stood at 42 million, same as Q2 FY24, which resulted in an average transaction size of rupees 2,680 in Q3 of FY24 compared to 2,753 in Q2 of FY24. We expect the normalization of UPI economics from February onwards will improve the above-mentioned numbers in Q4. Gross take rates increased sequentially from 32 bps to 34 bps in Q3 of FY24, while net take rates increased from 5 bps to 6 bps on account of improving unit economics and internal efficiencies. Our financial professional network increased by 12% year-on-year and stood at 5,713 as on 31st December 2023. We further processed 26,099 loans through our network in Q3 FY24 and reported an increase of 453% year-on-year and 36% quarter-on-quarter. Moving on to the consolidated financials for the quarter, our revenue stood at rupees 53.8 crores, up 99% year-on-year and 13% quarter-on-quarter. The revenue increase was driven by prior quarter service revenue and marginal sequential improvement in take rates. The adjusted EBITDA loss narrowed from rupees 8.2 crores in Q2 FY24 to rupees 1.4 crores in Q3 FY24 due to improving economics in the lending and distribution business. ESOP charge for the current quarter was rupees 0.3 crores versus rupees 1.1 crores in the previous quarter. The non-GAAP PBT stood at negative rupees 4.5 crores in Q3 of this year as against the negative non-GAAP PBT of rupees 10.1 crores in the previous quarter. Our consolidated cash and cash equivalents stood at rupees 93.1 crores as on 31st December 2023. So with that, we can now open the floor for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Yash Modi from Ashika Group. Please go ahead.
Hey, good morning, Paz. Good morning to the team.
Hey. Good morning, Yash. Thank you for joining the call.
My pleasure, sir. Congratulations on clearing that UPI issue much ahead of schedule. We were expecting Q4 also to face that. My first question is with respect to the receivables in the iServe platform. This is the third quarter now that we're having some issues with receivables. So what are the nature of these receivables? Well, I understand that 80% of it has been provided. How confident are you of the fact that we are not going to repeat in the coming quarters? This is my question, sir.
Yeah, I think if you look at our receivables, right, we normally break up our receivables between bank and non-bank receivables, right? There is a bunch of receivables that come as part of regular process, which are bank receivables as we are doing our, settlements, etc. So that works as a normal thing. That typically is less than 30 days and there's no issue there at all. There have been receivables the previous time when we did some receivables, they were specific to individual customers where we knew that recovery was possible. This time the receivable is driven by the ECL model. So it's a model number that is thrown up. This is the aging of receivables. I think none of the receivables we've taken provisions on, these are not specific to any individual customer. The model throws up a number and that tells us to provide a certain amount. So that's why from last time, what we did last quarter, we cleared out specifically issues that were related to specific customers. This time it is just basis the model throw up on a conservative accounting method where the model told us to provide for X amount because these receivables are going beyond the comfortable pace of aging. Typically the receivables that come into this category are receivables where we've done software sales, where customers need to see their business scale up before they start paying us. But they are all existing customers, none of these customers who are not working regularly with us, which is why the possibility of significant recoveries in Q4, I think, is a high possibility for us.
Got it. Second question is with respect to the GTV that is seen in January. So GTV for January stands at 3,450 crores. So now if I look at, obviously if I annualize it, it is like the third quarter where we're kind of having a flattish GTV. I understand that from February onwards, UPI is expected to pick up and there'll be some traction on that, on lost business. But how confident are we of, I understand that you'll be able to meet your 500 crore revenue guidance because the loan book is scaling up quite well. But how confident are you as a team of meeting that 1 lakh crore GTV mark that you set for yourself for FY25? Because there's some slowdown in AEPS. Like it's a sector slowdown. I'm not saying it's specific to Niyogin, but we can see some.
Yes, absolutely. So, no, absolutely. I think there is a sector slowdown in AEPS, and you would have read all the press articles on AEPS, right? So that is there. We've not seen a significant slowdown. Our AEPS volumes continue to grow because our business model is slightly different, right? Our business model is about acquiring customers who are currently working on AEPS. So that model continues, and thanks to that, we will continue. We've not seen slowdown in any of our individual product stack, AEPS specifically, right? In terms of where we think next year will look like for us, firstly, the UPI volumes have to come back, which again, we are very confident. January, does not have any UPI volumes in that number because, as you know, that business was just being recast in a different light, which was done towards the end of January, and February I think we've started again. I think you won't see the full benefit of this in February because the customers are still scaling up. March is when you will see the full benefit of the UPI business back on track, right? That's number one. Number two, as I had mentioned earlier, we've created the entire card stack. The card stack has taken a bit longer to get activated. We now have customers. I think from March, we will probably have the volumes of the first customer coming in on the card stack, which is the prepaid card stack, which is one of our key customers. There are 3 other customers who also signed up, but there are integration, efforts happening. So I know for one customer, we will definitely go live in March. For the other customers, we may go in April. Now, depending on how the card business scales up, we'll have to figure out how to reach our target, right? The existing business, I think, if we can try and solve for anywhere between 4,500 to 5,000 crores in March of GTV, then we are working on a run rate of almost 60,000 crores for next year, right? Just starting out, and then the growth of next year will help us take us closer to the 1 lakh mark. That's the plan. But like I said, right, there are these challenges that have come and hit, especially UPI. Depending on how that scale up happens and the new product launch of cards are the 2 main pivots on which we think this business can scale up. The other regular businesses continue to scale up. There's no issue with the other businesses. AEP has went through a challenge that will come back because it still is a significant solution for rural markets, right? I think Central Bank and the regulators understand the importance of that, which is why incremental checks and balances have been brought into the APS business, where now it's a 2-factor authentication, as against earlier it was only a single-factor authentication. So the regulator is bringing in incremental solutions. That's one. The number three is we've also gone live on our account opening proposition. The account opening proposition, we are working with 3 banks where we have economics which are based on just fee economics and some sharing of float, etc. That has been organized with the 3 banks, and that business also is just about starting to scale up. I think there is some opportunity that will come that way, and if you are able to successfully navigate against the entire artificial intelligence acquisition that we are looking at, I think there we will not only use it as a toolkit for our own use, but we will also sell it in the market as a solution for our partners. And if you really look at the more recent focus on KYC, that the central bank has been making, this really provides a solid solution for KYC solutions, especially in markets where you have limited connectivity and far out markets where documents are necessarily not very clear as much. Using the AI technology, what has been built is a very, very smart solution for being able to, activate AI and even things like, Aadhaar masking, etc., is completely automated. So we think all these new ideas, new thoughts are going to be the reason why we'll try and, push for our stated target of 500 crores and the 1 lakh crore GDP.
Got it. We've done a very good job of reducing our registered EBITDA losses to 1.5 crores during the quarter. Now, with the UPI issues behind us and the loan book scaling up, is it a fair assumption to make that Q4 will be our first EBITDA positive quarter?
I don't want to give you a forward-looking guidance. Obviously, the aim of the company is to become profitable as soon as possible. So we are doing everything, including looking at our expenses and strategic, elements of how we can reduce costs while trying to push the revenues up. So the aim is to get there as soon as possible. This quarter has been satisfying. I mean, if you take the provisions out, we would have been, on a PPOP basis, we would have been positive anyway this quarter, right?
Correct.
And if the provisions come back, then there is a high probability that we could be a bit positive. So the entire team is super focused on trying to get that done. I think it's a very important milestone for us, and we want to get there sooner than later.
Got it. And we stick to our guidance of closing FY24 with a loan book of around between 200 to 210 crores. And if you could just comment on the way we are scaling up the distribution income, that will be my last question. Thank you.
Yeah, I think the loan book 200 crores, I think, is visible. 200, 210 is absolutely visible. We have the liquidity. We have the liquidity to achieve that. We have the partnerships, right? And we are anyway disbursing anywhere between 25 to 30 crores a month, right? Obviously, there are repayments that come in. and we have the potential to scale up, but we are just being sensible in not just overloading on the lending book, right? We are going sensibly because managing risk, I think, as you mentioned, is an important pillar, as I mentioned earlier, is an important pillar how we are building our business, right? So obviously the revenue, the economics are superlative, the unit economics are superlative, so there is some incentive we're trying to scale that up, but we are trying to do it sensibly. That's one. I think on the distribution side, again, we've seen some pretty good traction. This is part of our CA network. We have more than 5,500 CAs that log into our platform NeoBlue. And NeoBlue is a digital platform where a customer can log in and apply for a loan. We have more than 30 partners that work with us. These are lending partners, apart from Niyogin itself being a lending partner. And our plan there is to keep making some fee income, on the distribution of unsecured business loans. So that business is going quite well. On an average, we typically make about 30 to 50 lakhs a month of fees, gross fees. I think before March, we should probably scale that up to at least 50% more than that target. And then next year, I think the number is going to be quite substantial. The adoption of NeoBlue also seems to be now getting, done pretty nicely. As you know, we just launched NeoBlue a couple of months ago, and we are now seeing good traction on that platform as well. Plus, I think there is incremental possibility of smoothening the process when we get the AI platform onboarded, right, where the entire journey will become a lot more simpler for the end customers. So, bunch of things being done to keep scaling that up. I think it's an interesting business which we want to keep investing in. It doesn't require capital significantly other than the employees that are dedicated towards that business, and it's a fee-based income proposition. So it's working well. So I do see hopefully some positives on that side of the business as well in the coming year.
Thank you. Thank you so much. All the best.
Thank you.
Thank you, Yash.
Thank you, sir. Participants who wishes to ask questions may please press star and 1 now. The next question is from the line of Pranav Gupta from Aionios Alpha Investment Managers. Please go ahead.
Hello.
Yeah, hi Pranav. Good morning. Thank you for joining.
Hi, good morning. Good morning, Dash and team. Congratulations on a good set of numbers. Couple of questions. Just one as a continuation to the previous one. You mentioned that the provisions that we made this quarter are based on, what the results of the model throw up. Just wanted to confirm whether these are the provisions on the loan book that we have on balance sheet or against the receivables that we have to the banking partners that we onboard.
Yeah, this number was related to the banking partners, not about the loan book. This was referring more to the banking partners, which is on the IServU balance sheet, not on the Niyogin balance sheet. This is not a Niyogin standalone issue. This is the IServU thing, which is also what we've had in the previous quarters, right? In the previous quarters also, it's always been materially. There'll always be a small ECL that will come in the loan book as you keep growing up the loan book, right? That's as per regulations, right? There's a statutory provision that needs to be taken, but that's not material. This is specifically referring to the IServU receivables, where we've implemented under Ind AS you're supposed to have a ECL model for the receivables, right? So that model has been implemented, and basically aging, right, and the expected credit losses, a number is thrown up, which we are required to provide. I think that number, as the business grows, will keep moving up and down a little bit. We are hoping it will move down this quarter, which means that we'll show more recoveries this quarter. And then, as the business grows, there will always be a small delta which will keep looking out on that side.
Right. Just to understand this a little better, so if I understand this correctly, what you mean to say is that as and when you keep onboarding new partners on the banking as a service business and the receivables keep growing with the GTV, you'll have to make certain provisions based on the ACL model for those receivables, right?
Yeah, I think it's more it's more penalizing when the aging is higher. At lower aging, there is very minimal penalty, right? So, for example, all the banking partners we have there, the receivables are typically less than 30 days, so there's hardly anything that comes in. With the other partners, where you're selling software, or in the past we have sold devices, where there is always this need for them to say that let us make money on this business, then we'll pay you, right? So that leads to some level of a delay at their end, which is where these issues come in. Now, in the past, what we've done, where we've had negotiations, we've done settlements, and whatever the balance settlements are left, those have been provided for the previous quarter. This quarter is not like that. This
Right.
quarter is about just the number that's coming up. These are existing customers where there is some aging, and therefore, rightfully the ECL model throws up a number, and we have to keep providing that.
Understood. Sure. The second question was on the UPI bit. So you mentioned that the issues that we had regulatorily based on some RBI requirements were sort of solved this quarter, as in by Feb. Could you delve a little bit deeper as to what kind of solution we have implemented, whether it's based on the application of the PAPG license or something else? Could you just throw some light on that?
No, it's not. It's not based on the application of the PAPG license. I think quite simply what we did was, earlier on. I mean, I'll get into a little bit of technical detail, but you can take it offline if you want. But just to give a quick summary on that, what we were doing earlier on was that we were having the nodal accounts and we were doing all the settlements, right? And the bank was only sponsoring our switch, right, for UPIs. We were doing everything, top to bottom, and we were getting paid a certain amount of economics for doing that, right? Subsequently, there was an interpretation taken that for doing that, to do all the settlements, to have the nodal account, there is need for a PAPG license to be brought in, right? So we took some clarifications from various market participants, etc., and we figured out that there is a solution to solve this, which required a tech development of basically becoming the TSP to the bank, which is a technology service provider, which the bank then does all the settlements on their own, which obviously we provide them with all the data and everything, but the bank formally does the settlement. So there is no need for a nodal account, but it required us to change the way the tech is oriented today, and that's what took time. Obviously, we needed to work with a few banks to get the agreements redrafted to allow for that. And effectively, this business has become, we are now like a TSP, technology service provider to the bank. But the good thing is that our economics have been protected. Because we are doing everything for the bank in the way we've been able to negotiate. Our economics continue to be protected. And as far as the customer is concerned, the customer sees no impact. Technically, the bank is doing what it's allowed to do, and we are doing what we are allowed to do. So there is no infringement on any regulatory issue at all. This is an absolutely squeaky clean structure, which works well. And just the implementation took time for two reasons. One, we needed to work with a few banks to revise all our agreements and think through the structure, get clarification on the cultureness of the structure, and then build the tech to make sure that the system can be reoriented to allow for this to happen.
Right. Great. That explains it, and we can take it in detail offline. Just one last question from my end. The NeoBlue platform, you mentioned that we're doing about 30 to 50 lakhs of fees every month. Where do you see this, given that you also mentioned a new partnership that you onboarded? Where do you see this over the next year or probably the next couple of years? What potential do you see in this business?
Yeah, so I think NeoBlue is a very interesting proposition. Yeah, it feeds into both the distribution part of our business and into the lending part of our business. So what happens is that when a chartered accountant is working with his MSME, his client, right, his or her client, and they want to apply for a loan, they just put it up on NeoBlue. NeoBlue stack tells them straight away whether you are eligible or not, tells you what amount you are eligible for, right? And the entire journey is fully digital, right? Everything comes to us digitally. And then we have a decision tree, again digital, where we can decide whether we should hold the loan in Niyogin if it meets our credit norms, or should we just give it to one of our partners. So there is a, what should I say, a decision tree analysis that's done. And if it goes into a distribution partner, then we make the fee income. If it goes into our own books, we make some fee income, but we also make the lending income. So if I just take only the distribution piece without talking about Niyogin holding that loan on their own books, that is the fee that I was referring to, which was between 40 to 50 lakhs a month. Right? That number should very easily over the next quarter become 1 crore a month, because this business is scaling up. And tech will allow us to scale the business faster, because the whole point of doing it through tech, right? Otherwise, we could have just thrown bodies at the job. We're not throwing bodies at the job, we are throwing technology at the job. And, if we can solve for anywhere between, this year, I think overall we would probably make between 4 to 4.5 crores of gross revenue. If we can solve for 10 to 12 crores next year, I think that will be a good outcome as the first real year, because NeoBlue adoption, as I mentioned, is just taking place right now, right? It's only been 2-3 months. If we can get to that as our first milestone, I think that will be a great outcome for us.
Understood. Sure, Tash, thank you so much, and good luck for future quarters.
Thank you. Thank you, Pranav.
Thank you. A reminder to all the participants that you may please press star and one to ask questions. The next question is from the line of Vishruth Bhupna, an individual investor. Please go ahead.
Hey, Tash. Am I audible?
Hi, Vishruth. Good morning.
Yes.
Thank you for joining.
Good morning. So, first question is just around the PAPG license. Just wanted to understand that, given that the UPR problem was solved, are we still contemplating going ahead with the license, given that, I'm seeing a lot of market participants go for it and, maybe with incremental future products it could come in handy. I'm just curious as to how we're thinking of that.
I think, simply put, Vishnu, if you're asking me, is there value in getting a PAPG license? Absolutely. No question about it. We're doing some work. I have a team that's working on actually mapping out a full business strategy on what could we do if we had the license. Now, whether we have the license or we partner with someone who has the license, I think these are things we are exploring. But if you ask me, is there merit in the company getting hold of regulatory licenses like PPI, PAPG? Absolutely. There's no question about it.
Understood. And then just on the banking as a service stack, just wanted to understand about, what has been the incremental customer additions in the last quarter? And is the account opening products that you had mentioned earlier, is that counted under the banking as a service stack, or are these customers with whom we had a pre-existing relationship who were upselling more incremental products to?
So I think the account opening is part of the banking as a service app, right? Because if you really think about larger clients that we have, they all want their customers to open accounts. Now, accounts could be actually for the retail outlet, or it could be savings account for the people that come and serve themselves in the retail outlet. So again, we are only providing solutions and services to our partners who are then able to deploy this in their networks. So banking as a service is part of the iServe platform. No reason why it cannot be used in NeoBlue. The opportunity is just to throw up. I mean, these are things we are just thinking, and these will all need, for example, every time we give a loan, why can we not have the customer open an account with us and we disburse the money into the new loan account, right? And have all EMIs being paid from the new loan account, and therefore promote the usage of the new loan account, right? So there are a lot of ideas and thoughts about what account opening can do for us across the entire platform. But the product was developed as a solution required by one of our large, banking as a service partners, right? And therefore we developed it. And obviously, once you get one anchor customer, then you try and develop it and then try and sell it to all the other customers that are there. We're also quite happy that we got 3 banks to agree on this platform with us. One of them is a very large bank, right? And the other 2 are smaller banks. But nevertheless, the solution works. And unit economics are quite good. And we think the unit economics can be enhanced by deploying it in our own platform. Niyogin could use it on a standalone basis as well, which we are not using today because we're just waiting for the platform to become, stable and get some volume under their belt. And then we'll be deploying it here as well. So a lot of internal synergies exist as we bring these new propositions into the market. But we track the businesses separately because I don't like to confuse numbers, etc., right? So I track whatever work gets done in the banking as a service platform or in the account opening, everything will get tracked in iServe's numbers. If Niyogin lands up using that solution, Niyogin will pay for using that solution to iServe. If iServe uses some solution that Niyogin provides, for example, the AI platform that we are looking to acquire, iServe has a great use case for deploying that in their platform. They will pay Niyogin for using that solution. So I think our philosophy is to use proper arm's length so every team is suitably motivated and commercially focused and also therefore compensated for providing solutions to other members within the same team.
Understood. Thank you. And then next question is around if there's any update regarding the remaining stake in iServe and how we're thinking of going about that.
Yeah, I think no update really to give to the market just yet. We got busy with a couple of M&A situations, quite honestly. And while one we have signed a non-binding term sheet, there are a couple of others that we are actively looking at. So that sort of took a little bit of a backseat, and I want the business to start becoming profitable. But it's certainly on the cards. At some point in time, we will do it. But nothing to really report or update right now to the group.
Great. And then final question was just more like, sector-wide on EPS. Do you feel at least from the feedback you're getting from on the ground, is the slowdown more because of the friction caused by, let's say, additional two-factor authentication or, that ease of making the transaction has gone down, or is it just a migration to UPI in areas where EPS was earlier having a lot of high volume?
No, I think the AEPS story is a little more complicated. I think it all started when there was there were more frauds happening in the AEPS network, right? And this is all in the public domain, where I guess in some part of northern India there were some land records stolen or sold with the result that people got hold of the fingerprint data and the Aadhaar data, and they were able to create these small stickers on fingers and go and start withdrawing money. So AEPS actually, the UIDAI did two things. One, they actually gave individual consumers like you and me the option to go and switch off AEPS so no one can use your data, right? Which I suggest if all of you haven't done it, you guys should do it because it will protect your data. Number one, no one can use your account by cloning your fingerprint. That's one. And the second thing that happened was that the regulator reacted pretty quickly and started creating a two-factor authentication, which means you required a cell phone, right, or SMS for the AEPS transaction to get done. Now, you would remember the big success of AEPS was because it just did not require anything. You could walk into a store with nothing except your fingerprint and the Aadhaar card number, right? And you did not need a physical phone, etc. Now, SMS does not require a smartphone, right? So the proliferation of non-smartphones is almost 100%. Therefore, that doesn't hold back. But surely, anytime you add a new process or a new leg into a process, there is some slowdown that happens. Also, I think there was some concern. People got worried whether, the frauds that have happened, banks got worried in terms of trying to not push the product. I think the regulator is still very focused on trying to push the AEPS proposition because it is, in my view, I think it's one of the best innovation we've seen as far as financial inclusion is concerned, right? So protecting that innovation, making sure fraud controls are in place, etc., are very important for this business to scale up, right? So we are I think, ahead of the curve on all of that in terms of building our fraud control mechanisms, etc. So I think the volumes will come back. But there's been a slight slowdown. Every time there is a little bit of a hit like this, there will be some slowdown. I'm talking about the industry overall, right? So we'll see how that goes. But I still think the product is extremely relevant from an India standpoint. The other good thing or other corollary benefit of this is that the micro ATM business will start taking off in a big way, which is again one of our big products, right? So because people still need to withdraw money, people still need to, find ways to work and get liquidity in their hands. So if AEPS goes slow down, the micro ATM is a fully secure product because you're using a card to withdraw money. So it will again propel the cards business, which by itself has a significant upside for us. So as far as I'm concerned, between AEPS and micro ATM, it's like a balloon with some water, right? You press one side, the water goes to the other side. So as long as we can capture the volumes between the two, I think we are easy anyway. The economics are similar for us. And, so it works well, yeah. So not a big issue for us. I think this will come back in a big way.
Understood. Thank you. Best of luck.
Thank you.
Thanks.
Also, Vishwas, if I can just add to that, why the AEPS volumes overall in the industry are getting impacted is because a lot of these issuer banks, these AEPS transactions are actually a cash drain. So what they've gone ahead and done is imposed restrictions on the amount of cash that you can withdraw. While NPCI does not have those limits in place because of the economics of these banks, they've also made AEPS a little difficult for the user to use. And while NPCI and these banks are currently in discussion to figure out a way how to make the economics for both sides, the fact that is at this point in time, the issuer banks, because it's a negative cash drain for them, will incentivize users from using AEPS. So that's also having a little bit of a negative impact on the overall industry volume, apart from the
Well, thank you.
Thank you, ma'am.
Yeah.
Before we take the next question, a reminder to all the participants, you may please press star and one to ask questions. The next question is from the line of Nikhil Kumar Agarwal from VT Capital. Please go ahead.
Hi, how are you? How are you, sir?
Hi, Nikhil. How are you?
Thank you. So congratulations on a good set of numbers. Just two questions that I have. First, if you could give more color on what M&A deals we are looking at, like you mentioned. And second, in order to achieve a 200 crore loan book by year end, we will have to show 25% year-on-year growth in the quarter 4. Okay, and we have been showing 15-17% run rate. So are we confident of achieving a 25% or above growth rate by quarter 4? And the first one, M&A deals.
So I'm sorry, I couldn't hear the second part of the question. There was some static, but I'll answer the first one, and then maybe I'll answer the second one.
Yeah, I'll repeat the question. Okay.
Sir, actually, there is a disturbance from your background, Mr. Agarwal. Yeah.
Okay. Am I audible now?
Yes.
I have two questions. Number one, if you could talk more about the M&A deals that we are looking at, what M&A deals we have in the pipeline and what we are focusing on, like you mentioned. And secondly, in order to achieve a 200 crore loan book by year end, we have to show 25% year-on-year growth in the quarter 4 of this financial year. And we have been showing a 15-17% kind of run rate. So are we confident of achieving 25%? If yes, how? And just that, these two questions.
Yeah. So I think on the M&A side, if you look at our presentation, we've detailed out one slide on the AI strategy for our company.
Okay.
Right? And the first, so I would urge you to go through that slide. It's on the public domain. It's on our website. It's on the BSE website. That's one. Number one, let me complete that. And I think the first transaction that we're doing, we've already put out there that we signed a non-binding term sheet with a company to acquire a platform, which is again an AI-based platform, where we will get the toolkit and we will get the team. So we're looking to get a bunch of engineers as part of the whole thing, AI engineers, who will then become part of our development team. And we will get the technology along with the current set of customers, etc., revenue, all the other nice things. We think we can significantly scale up what this smart young engineers have built. Right. So that's point number one. We are hoping to get this done in this quarter. So fingers crossed on getting that across the line. We are in the midst of diligence as we speak. Other than that, there are a couple of other acquisitions where we haven't shared anything in the public domain, so I can't really talk about it, except that these are all situations where we think they are good bolt-on ideas and suggestions of businesses which either give us access to technology or access to a client base that we otherwise don't have access to, right? So that's really the driver, right? And obviously there could be potentially businesses where we could also get access to some licenses, which again will require us to go back to RBI and take permission. So those transactions may take longer to close. But as we get closer to any of those, we will announce that in the public domain. We've been fairly transparent in what we're doing with the street, right? And we have the capital, we have the wherewithal, now we have a business that's scaling up. So some of these solutions will anyway have some synergistic play within what we are doing. But more importantly, they will also bring with themselves their technology, their customers, and hopefully expand our product stack, which we can then cross-sell into our customer base. That's the way we are thinking about M&A. I mean, I can't really share names, etc. at this point in time. So that's where we are. On the second piece, Nikhil, yes, you're right. I mean, there is a significant growth expected next year. Like I mentioned, there are some new products that have been launched between the cards product and the UPI coming back and the account opening product, right? So there is optimism on how these products will scale up. I mean, no one has a crystal ball to give you accurately where this will come out. When we created the 1 lakh crore target for ourselves, we did that 3 years ago when we were like a 8,000 crore GTV number, right? And that's when we set a target for ourselves because the company needs a North Star, right? Everybody working in the company needs a North Star. And we were very transparent in going and sharing it out with the street, saying that that's what we are going to shoot for. I'm still optimistic we will achieve that target, right? And some of these new products, some of the challenges which one can never foresee, like the UPI challenge we have, are issues that are coming our way, but we are dealing with it. Slowly and steadily, we are dealing with all the challenges that are coming our way. So we remain optimistic depending on how the new products play out. The current businesses will grow, but getting new products in is important. Getting new partners in is important because we can get multiple scale jumps as we get a new partner. Right? As we got, we got one partner, for example, last quarter who just gave us 500 crores a month of GTV. So getting a couple of these large partners closed, I think, is very important. So there is efforts happening at multiple ends. There is new product proposition. There is existing partners who are scaling up their networks, and there are getting new partners who have networks but are willing to come to us because we are able to offer them either better economics or better tech or better, lead time for closing a transaction, right? When you're doing your transaction, how long does it take for you to actually get the deal done, and what is your downtime? All those things become relevant for customers as they think about working with us. So it looks positive, it looks good. We are quite optimistic and excited about it.
Hello, can you hear me, sir? Hello.
Yeah, I can hear you.
Okay. So thank you for that answer. My second question was on loan book, more on loan book and less of GTV, because I don't think for such a tech-enabled company, GTV is going to be an issue. What I'm concerned about is us achieving a 25% year-on-year growth rate by Q4 in our loan book, which we have not seen yet. So that was, my question was more on loan book. So are we confident of achieving that kind of growth rate for a 200 crore loan book?
And again, I'm sorry, but your voice is absolutely, there's too much static. I don't know if anybody else, Trivenika, did you catch the question? Then you can just tell me. I'm happy to answer. But what I got was you were concerned about the GTV of iServU, whether that will scale up. Is that correct?
Hello, can you hear me? I'm talking about loan book, not
sir, your audio is not clear, sir. I would request you to kindly use your handset, please. If you're using it.
One second.
Nikhil, hi, this is Trivenika. If I can just, based on my understanding, answer the question. You're basically concerned how Niyogin, the lending piece, is going to scale up?
Yes.
Okay. Got it. I'm sorry. I sort of misconstrued your question thinking about the GTV. So the lending business is actually the easiest to scale up, right? Because the lending business, how do we do lend? Right? I mean, if you look at the lending slides we put on the deck, our lending strategy is we do not have any branches. We're not going there acquiring customers. We don't have any significant sales on the ground to go and acquire customers. Right? A lot of our customers come in because we have partnerships, right? So when we've given examples of partnerships like Khatabook, etc., that have more than 5 million downloads, and they want to lend in their network, and we are working with some of our partners like Khatabook to create lending programs which are jointly underwritten, where there is some level of credit and return sharing that happens with them. Now, in that network, it's really up to us on how much exposure we want to take. We have more than 8-10 partners like this. I talked about Karma Life as a new partner that's come in, where we are lending in their network, right? They do the origination, they do the collection, we do the underwriting, right? And then we have an economic and risk sharing on how that plays out. So because we are partnership-led, rather than going and acquiring every single customer, as we acquire a customer, we get a significant number of customers. So as we acquire a partner, we get significant number of customers. So we are, like I said, we are anyway scaling. We are doing about 25-30 crores of disbursals every month today, right? And we've just about barely started our lending program, right? And our borrowing program rather, right? So we are taking leverage now to scale to the number. I think the Q4 target of 200 crores seems in the vicinity. I don't think that's going to be a challenge. I think next year we could easily get to between 400 to 500 crores on the lending side. Again, like I said, we are not jumping at it. We are going in a very calibrated manner. To some extent, people may argue that we are being very averse in terms of the risks we are taking. But I think it's okay. The returns are pretty good. We are solving for high teens. And so it's looking pretty good right now. I think scaling up there is just a question of getting more partners in rather than opening up large branch networks, etc., which a traditional NBFC would end up doing. That is not our thought. That's not how we are doing this. We are using technology and we are using partners and their network to be able to do the lending business effectively. It's a very differentiated model. I don't know too many other people who are doing this, in the way we are doing it. I'm sure there are people who are doing it, but we don't know too many other people. And it's very interesting because when we start thinking about other fintechs and other NBFCs that want to do co-lending with us, I think we have a long list of people who want to work with us, which I think is interesting. We're just biding our time on figuring out who and what we want to work with.
Great. Thank you. And best of luck for the future. Thank you.
Thank you, Nikhil.
Thank you. Participants who wishes to ask questions may please press star and 1 now. The next question is from the line of Pranay Khandelwal from Alpha Invesco. Please go ahead.
Hi, Tash.
Hi, Pranay.
Congratulations on good set of numbers. I just wanted to know, can you give us a timeline on the Super Scan deals? Like, how long will the diligence and all that might take? When can we see, if everything goes by the plan, when can we see them being inculcated in our tech stack?
Yeah, I think like I said, my motivation is to try and wrap it up this quarter, right? So of course we need to go through some level of the process as follows. We'll complete our diligence in the course of the next week, 10 days, right? Post that we need to go through the process of taking shareholder approval, etc. Right? So that itself will take a bit of time. It'll take about 25-30 days. But the integration and all this are happening anyway. Moment we are done with the diligence and everything, right? We didn't even start becoming a client, and we can deploy the technology any which way, right? It doesn't need for us to buy for the assessment and the benefit we could accrue in our platform. To sell that as a solution to third party, obviously we will need to make sure that the platform is under our belt before we can sell it to a third party. So I'm hoping before the end of the quarter we are able to announce this. We are already in mid-Feb, so talking about the next 30-45 days, we should have this under our belt.
All right. That's all. All the other questions were answered. So,
yeah.
Thank you.
Thank you.
Thank you. You may please press star and 1 to ask questions. Participants who wishes to ask questions may please press star and 1 now. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments. Over to you.
Yeah, thank you, Michelle. Thank you all for joining our call. We are operating in a fairly exciting space. Exciting space will also lead to certain challenges, which, touch wood, we've been able to sort of deal with. And we are very optimistic in the way things are. Please keep listening to our story. I think there's a lot to be told. There's a lot to be done in this space. And thank you again for taking your time out and listening to us this morning. Have a good day.
Thank you, members of the management. Ladies and gentlemen, on behalf of Niyogin Fintech Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.